Hey everyone, it's Ryan with Stock Investing and Trading 101. Today I'm doing my 1 year M1 Finance portfolio update. This portfolio was made January 7th of 2019. The current date is January 12th of 2020, making this portfolio just over 1 year old. Got a current value of about $34.25, nearly $3,500. And during the past 1 year, I got a $460 gain, which equates to about a 19% return. This was actually my first year investing in the stock market, and I'm so grateful that I decided to do it and that I decided to not only invest in my financial future, but also invest in myself and my financial education, because that is really what came first before I started investing, is that I did research, I educated myself on investing, dollar cost averaging, and things like that, and it paid off tenfold. So for anyone who's on the fence about investing, whether it be in stocks, bonds, real estate, whatever it is, I would just say to look at my situation and where I started, where I ended up during my first year, and I would just say to make sure that you either have a professional to advise you, otherwise to do your own research and really to gain an education, because the education is really what is going to help you make the money. So let's get into the portfolio. This is a dividend growth portfolio. All of these companies are paying me a dividend, and not only that, but the company is either growing or paying a growing dividend. So my first and biggest holding is Unilever, which has become my biggest holding because it was one of my worst performing stocks. I decided to take advantage of some of these stocks being in the negative for me and to buy more while they're low to lower my average price per share. It has a current PE ratio of 15.5 and about a 3.21% dividend yield, and it is somewhat of a defensive name. And for that reason, I've bought more, and it's become my biggest current holding. Next, we have Pfizer, the pharmaceutical company. This is currently at a 13.5 PE ratio, which is actually relatively cheap, and it's got about a 4% dividend yield. This is a great pharmaceutical company. They have a great pipeline of stocks. They have a growing revenue, and it's just a stock that I'm totally comfortable with holding. Third, we have Duke Energy, which is an energy company. They got about a 4% yield. I believe the PE ratio is about 19, so it is a little bit high on the PE ratio side, but it's definitely cheaper than the market and some of these companies. And I think energy is also somewhat of a defensive name, and I'm trying to make my portfolio as defensive as possible right now because I do want to continue to receive dividends, but I don't want to be subject to taking a huge hit during a possible correction, because we are at all-time highs in the stock market, and it is somewhat difficult to find stocks with low PE ratios or stocks that are currently undervalued. So my fourth holding is Chevron, which is an oil company at 17 PE ratio and just over a 4% dividend yield. I'm currently buying more oil companies, and specifically Chevron and a little bit of ExxonMobil and Royal Dutch Shell. But I like Chevron. They have a huge market cap of 220 billion. So this is an extremely large company, and the dividend is growing. And it is one of those stocks that if we went to war, that the stock price would more than likely go up. Typically, the stock price goes up when the price of oil goes up, and oil usually would go up during a war. It's considered a safe haven asset, and for that reason, I'm looking to hold a larger amount of it to be a protective part of my portfolio while also receiving that 4% dividend yield. Next, we have 3M, which is an industrial company. Not too much of a return from them, just at 3%, and they got a 3% dividend yield. Really, it's really nothing too special right here, in my opinion. Plus, they've had a pretty rough 2019, and I'm actually probably going to end up selling a little bit of this position. But however, it is a stock that could bounce back because it is pretty far from its all-time highs. After that, we have Clorox and Colgate-Palmolive, which are kind of some defensive names as well. They are a little bit on the high side of about a 25 PE ratio and less than a 3% yield. So these ones really I'm not really buying anymore. I don't think there's really anything special there. Next we have Hasbro, which has also got an extremely high 51 PE ratio, $13 billion market cap, less than a 3% dividend yield. Just don't really see. It is, a nice, very strong dividend growth stock, but just looking at the returns that I'll most likely be seeing from a company like this, it's not anything that I'm getting excited about. After that, we have Royal Dutch Shell, which is very similar to Chevron. This is an oil company. However, they have a PE ratio of 11.7 and a dividend yield of over 6%. So an extremely high dividend yield and a pretty low PE ratio. I think the stock is more risky than Chevron. They also have a very similar market cap. This is an international company. Mainly, I believe they're a European company, but it is something I feel a little bit more comfortable owning Chevron. However, Royal Dutch Shell does have a higher dividend yield. Next, we have IBM, technology company, yielding about 5%. They got a less than 16 PE ratio. I think this stock is something that I'm still looking at, still interested in buying. I do have a 10% return on it already, but I think this stock is something to look at. For a technology company and for it to only have a 16 PE, I think is relatively cheap compared to a lot of other technology companies. This is also something I'm going to be looking at some of the charts for these companies in my next video later today, and I'm going to be breaking down some of these companies, looking at their technicals. After that, we have Cedar Fair, which is up about 18%. They got a 22 PE, a nearly 7% dividend yield. This is a competitor to Six Flags. They have some amusement parks. I buy here and there, but I think they are a little bit on the high side of their price. After that, we have Waste Management, J&J, and British American Tobacco. So British American Tobacco is at a less than 13 PE ratio, yielding about 6%. J&J is currently at a very high 28% or 28 PE ratio with a less than 3% yield. So currently I'm not buying really any of these stocks. I'm just kind of holding on to what I have. Next we have Home Depot, which is a stock that I'm going to be breaking down later as well. But they have about a 22 PE ratio and a 2.5% dividend yield. It's taken a dip on its last earnings. However, it has made a relatively nice bounce back from there at this point, but it is still something that I could see making new all-time highs in 2020. We have Kimberly-Clark and BP. So BP is also an oil company that I'm really not buying much of right now, and the only reason for that is because I'm buying some of the other ones, and they also do have a 27 PE ratio, which is a little bit higher than some of these other ones. And we have Kimberly-Clark. Kimberly-Clark is something that I'm buying. They have a lot of consumer staples. I believe they own the Huggies brand and the Kleenex brand and some of these other brands. But they have a less than 3% dividend yield, somewhat of a high PE ratio, and it's not something that I'm currently buying. After that, we have Leggett & Platt, which has gave me a 45% return, which is one of my highest returning stocks. They got just over a 3% dividend yield. They got a 23 PE ratio. Not currently buying the stock just because it has ran up 45% in 1 year's time, and I'm just not really comfortable buying at this point. So for the next 5 or 6 stocks here, which is Universal Corporation, General Mills, Air Products and Chemicals, Philip Morris, PepsiCo, and Procter & Gamble. These stocks have all produced pretty significant returns, starting at 14 to 34% returns. And I'm currently not buying any of these companies. Procter & Gamble is at a 78 PE. We have PepsiCo. PepsiCo is relatively somewhat cheap at 15.5, but it's definitely not a bargain basement price. So for these companies, I like the company and I like the dividend. However, It's just a little bit too pricey for me currently. I'm trying to really buy stocks that are at bargain basement prices. So General Mills is something that I think is definitely buyable at these levels. I'm just not currently buying it. General Motors is probably the most speculative company in this portfolio. They have a bargain basement PE of 5.7, yielding nearly 4.5%. And I'm going to be talking more about this company in my next video when I show their technicals on this company. So I don't want to go too far into it, but it is speculative for me. It's down 6%. It really has no reason that it should bounce back, but it is something that I'm willing to invest in. Also, Warren Buffett's a shareholder, and I mean, that's good enough for me. Next, we have Apple, which is nearly doubled in price, currently up 84%. This stock, it was one of my biggest holdings. I've taken a lot of profits because it's doubled for me. I wish I didn't take profits so early because the stock is making new high after new high after new high, and I've really missed a lot of potential profit because I sold too early. But you can't cry over spilled milk, and I still did double my money. After that, we have Caterpillar, Walmart, Southern Company, Norfolk Southern, Bank of Montreal, Bank of Hawaii, and all of these companies are up significantly. They're not stocks that I'm currently buying because, I mean, they're just too expensive for me, flat out. And Starbucks is something that I was looking at. It's got a 30 PE, less than 2% yield, and I think it was at a decent price not too long ago, but I think it's kind of made its move back up. And then to finish this off, we have Campbell's Soup, McDonald's, UTX, Coca-Cola, Altria, and OXY. So all of these companies, McDonald's actually just made a nice move upwards, and I sold most of my position. It broke back above the $200 price point, getting me an 8% return. It's actually one of my biggest holdings on my stash portfolio, and I took some profits there. But these are companies I'm still holding. I'm just not buying. I'm only buying very selective companies right now, and I'm holding a lot of my portfolio in cash, actually. I think I have $600 or so sitting on the sidelines, just waiting for something to become cheap so I can buy it. And my other portfolios are exactly the same. We have the taxable, same holdings, just different amounts. So I'm not going to go through that all the way again. And we also have this one, the same things, just a little bit less of them. So that's the portfolio, guys. That's the 1 year, I guess, returns that I saw so far for my portfolios. I'm extremely glad, and hopefully 2020 is another strong year, and we can get some nice returns, guys. As always, thanks for watching. Don't forget to subscribe to the channel, like the video, and check out my other videos. Thanks for watching.